So you've made the decision, you are going to buy a house, and now you're faced with, well, which mortgage program is the right one for me and my family? So whether this is your first time buying a house, your subsequent time buying a house, you know there is a myriad of options, and which one is the right mortgage program for you? Well, you're in luck. We've broken out the whiteboard. We're going old school today, and we're going to do a deep dive into all the different mortgage programs that are available so that by the end of this video, you know which one is the right one for you and your family. My name is John Ritter, and we love helping first-time home buyers, move-up buyers, relocating buyers, whether you're moving in 9 days or 90 days, we're here to help. Send us a text, shoot us an email, or give us a phone call. All of our information is down below so we can reach out and connect and help you with your next upcoming move. With that, let's get started. So we have what I call Mortgage 101. And you're going to see on the whiteboard here, we have two different categories. One I'm calling programs, and the other one I'm calling types. Now, under programs, there's typically 6 programs. There are a couple other programs that are out there, but the 6 most common programs that you're going to see, and we're going to start with the first one, which is conventional program. The conventional umbrella typically makes up about 80 to 85% of all mortgages out there, and they're backed by Fannie Mae and Freddie Mac, the 2 quasi-governmental agencies that regulate the conventional business. Now, with the conventional loan, you're typically going to need either 3% or 5% down payment with a conventional loan. Now, the reason why I say 3 or 5 is because the 3% down option is limited to only those folks who make below the income cap for the program. So if you make above that income cap, then you're going to have to go to the 5% down option. Now, one little secret here, it does not go by household income. It only goes by the income that's on the loan application. So between you and whoever else is on the application with you, if you don't need everyone on the application to qualify for the mortgage, just take one person off, and if that person remaining, if their income is enough, you can get away with the 3% down. So that's Fannie Mae, Freddie Mac. Now, with also on a conventional loan, anytime that you don't have 20% down, you're going to have PMI, and this is going to be a reoccurring theme as we go through these different options. And let's pause for a minute and talk about what PMI is. PMI is insurance, but it's not insurance for you. It's insurance protection for the bank. And the way that it works is if you have less than 20% down, you have to have PMI. And that PMI, the way it works is when the bank makes a loan to you, they take out an insurance policy. And that insurance policy protects them so that whenever, if you were to stop paying on the mortgage and they have to now foreclose on it, when they go to sell that property, when they get the money back, if that money does not equal at least what is owed on that note, that insurance kicks in and pays them the difference. So on a conventional loan, if you don't have 20% down, you got to have PMI. Now keep that in mind as we move down through here. The next popular program is FHA. FHA is the bank and working with the Department of HUD through the Fair Housing Administration to make a loan for you. With FHA, you need 3.5% down payment, which is a very nice feature, especially if you're a first-time home buyer. And FHA also has PMI. FHA calls it MIP, but they also charge not only monthly, like on the conventional loan, that PMI is going to be a monthly charge. With FHA, it's a monthly charge, and they also charge an upfront fee. Now, to make it easier on you, FHA says, you know what, we'll go ahead and just roll it into your loan so you don't have to take it out of your pocket. So they help you with that, but you're paying part monthly and part upfront. The next popular loan option is the VA loan. That is a loan made through the Veterans Administration for our service members, those who are veterans or current active duty members in our military. What's nice about the VA loan is that it's 0% down. So a veteran, as you know, thanks for their service to our country, they can get into a house with 0% down for their down payment. Now, the way the VA handles PMI, there is no monthly PMI, but they do charge an upfront fee to use the program, and that upfront fee, again, they roll it into your loan so you don't have to come out of pocket with it, but that's how they take care of that PMI, that insurance, but there is no monthly insurance included in your monthly payment. Very similar to USDA. USDA is a great program. but it is location specific and it's also geographically specific. So what I mean by that is it has to be in a quote-unquote rural area because the USDA program is through the U.S. Department of Agriculture, and they're trying to encourage and promote home ownership in quote-unquote rural areas. So if you want to know if a house that you're interested in is eligible, just Google USDA property eligibility. It'll bring up a map, you put in the address, and based on the shading in the map, you'll be able to tell if that property is eligible for USDA financing. So if it is, you've checked off one box. Now the next box is USDA goes by household income, and it's based on the number of people in your household, but there is a limit to how much you can make. And this is regardless of who's on the application or not. They're looking at all of the income coming into the house. You have to be under their income limit. Same thing, just Google USDA income eligibility. It'll bring up a calculator. You can put in your household income, the zip code that you're looking to purchase in, and that will tell you if you can use that program. So if the location checks the box, the income checks the box. What's nice with the USDA is this also 0% down. So you can get into a house without any down payment. And USDA is very similar to FHA. You have a monthly PMI charge and an upfront charge in order to use the USDA program. Now the next category you may not have heard of too much of, but it's a relatively newer category of loans that has become more prominent in the last say 3 to 4 years. And as we're recording this is the end of 2023. But non-QM is really a subcomponent of the conventional umbrella. What non-QM is, and it stands for non-qualified mortgages. And the way that it works is you have large hedge funds, banks, portfolio lenders who they have their own money, and they're not going to lend the money based on Fannie Mae and Freddie Mac rules. They're going to come up with their own rules, and they're going to lend that money out. So under this category, you have two popular options. One is called a bank statement program, and this is really for folks who are self-employed. So self-employed people, if they have a good CPA at the end of the year, the CPA goes through their income and expenses, and you're able to deduct certain things that W-2 employees are not able to deduct, like depreciation, mileage. So their income can look a lot less on paper than what it really is. So what the bank statement program allows you to do is you can either provide 12 months or 24 months of bank statements. If you provide 24 months, you'll get a better interest rate because you're allowing the bank to take a look at over a longer period of time. But they'll look at your bank statements and they're going to add up all of your deposits from every single month. And they're going to use that as the starting point for your income. So they add up all the deposits, and then they're going to apply an expense factor, because we all know that it costs money to run a business. There's no business out there that costs nothing to run. And if you use the default expense factor, it's 50%. So for example, let's say you add up all the deposits into the bank statements, and it's $200,000 in deposits for the 12-month period. Well, if we cut it in half, 50%, that means they're going to say your income is $100,000. And that's what they're going to use to qualify you on the mortgage. So it allows you to get a better number for income than what's necessarily showing on your tax returns. You can also, if your CPA can vouch that it costs less to run your business, meaning it doesn't cost me half of my revenue to run my business. Maybe it only costs me 40% or 30%, 20%. If you can provide a CPA letter that says that, then the bank will use that as the expense factor. So if you have $100,000 in deposits and the CPA letter says it's only 20% to run the business, then the bank will count your income as $80,000 for the year. Now the next program is called the DSCR, and what that stands for is the Debt Service Coverage Ratio. This is specifically for investment properties. And what's nice about this program is it does not take a look at your personal finances. All it does is it looks at the property and the property's ability to cash flow. So as long as the mortgage payment and the rent income are equal, we call that 1-to-1, they'll give you that loan. If the mortgage payment is less than the rent income, so the rent that's being generated on that property is more, Even better, the bank will actually give you a better interest rate when they see that that property is cash flowing. So they don't look at anything to do with your personal finances. They don't look at your tax returns. They don't look at your W-2s, your pay stubs, none of that. It's strictly the property and its ability to cash flow. Now with the non-QM options, with the bank statement program, you're going to need at least 10% down. And with the DSCR program, because you're buying an investment property, you're going to need at least 20% down. Now this last category that we're going to touch on today in our video is jumbo. And basically jumbo means big. So you're borrowing big dollars, big money, and Fannie Mae and Freddie Mac have what they call a conforming loan limit. In other words, they are willing to guarantee, insure up to a certain amount. And that amount is $766,550. That can change based on where you live in the country. There are what's called high cost areas where that number is a little bit higher, but for most of the country, $766,550. So if you borrow $1 more than that, you get moved up into what's called a jumbo category, and there are different rules for that. Now, technically speaking, you only need 10.1% down. Yes, I know that 0.1, you might be thinking, why is that? It just is. But the interest rate for that is horrendous. So typically what you're going to see is 20% down, 25% down on jumbo, where you're going to see more realistic or more palatable interest rates that you wouldn't mind having. So these are your programs. One of my pet peeves is when I see other folks talking about different mortgage programs, they will include the mortgage types, which is fixed rates and adjustable rates. These are not programs. These are types of mortgages that you can actually get, for the most part, on any one of these options. You can get a VA loan with an adjustable rate mortgage. You can get a VA loan with a fixed rate mortgage. So can you on conventional and FHA. USDA is typically just fixed rates, but my point is, these are just mortgage types. Now, the most popular, the one that most people go for, is the fixed rate mortgage, and you have 5 general sizes: the 10-year, 15-year, 20-year, 25-year, 30-year, which is what most people go for. But your interest rate is fixed for the entire life of the loan, and nothing ever changes. We do have some lenders that will allow you to pick. They call it pick-a-pay, which means if you want to, say, pick 11 years or 16 years or 22 years, that's fine. They'll allow you to do that. So when interest rates are coming down and you're thinking about refinancing, instead of having to start all over at a 30-year, start your 30 years over again, you can stay right where you are, take advantage of that lower interest rate, and keep going. Technically speaking, the lowest number of years that you can do on a fixed rate loan is 8 years. So keep that in mind. Now, adjustable rate mortgages. I love adjustable rate mortgages. Adjustable rate mortgages get a bad rap from a lot of people, but it's a great tool if you know how to use it. You may hear it referred to as an ARM, and they typically come in 3 popular ways: the 5-year ARM, the 7-year ARM, and the 10-year ARM. Now, that first number that you see on the board here, the 5, 7, and 10, that talks about the initial fixed period of that interest rate. So let's use the 7-year ARM as an example. If I have a 7-year ARM, that means for the first 7 years, my interest rate is going to stay the same. At year 8 is when it's going to come up for adjustment. And that's what this second number is alluding to. The one that you see in all 3 of those is telling you how often it will adjust after the first change date. So if I have a 7-year ARM, it's going to adjust at year 8, year 9, year 10, year 11, year 12, all the way to year 30. And it's going to change annually on my anniversary date. Now you might be saying, well, why would anybody do that? Why would you want something that's going to change and you can't predict what's going to happen? Well, if you know that you're only going to live in that home for 3 years or 4 years, I would absolutely take a 7-year ARM. Or if you know, like right now, we're at a higher point in interest rates than we have been in recent years. If you believe, like I do, that interest rates are going to come down, you take the ARM because the ARM has a lower interest rate than the fixed rate. And the reason for that is the shorter amount of time a bank has to guarantee you the rate, that's less risk to them. The longer they have to guarantee you that rate, that's risky because they have to guarantee you that same interest rate for 30 years, no matter what happens in the market. That's risky. Whereas if they only have to guarantee you to it for 5 years, 7 years, or 10 years, that's less risk. Less risk means lower interest rate. So if you know you're going to be moving soon, or if you believe that interest rates are going to come down, that would be a good reason to take an ARM, because you're going to get a better interest rate while you're in that mortgage. Now, an ARM has two parts. You have your margin and your index. Your margin is the fixed component of the ARM. It will never change. A common margin is 2.5%. The index is what's variable. That's the part that can change. So what happens if we go back to my example of 7 years, at year 8, they're going to look at the margin, which is 2.5% in my example, and then they're going to go to the index at whatever the index is doing 8 years from now. There's a couple common indexes. One is the SOFR. The other one is some form of treasury bill, but they're going to look to see how that is trading. And so here in my example, let's say the index is 3% 8 years from now. So they're going to take the margin, 2.5, plus the index, 3, which means a total of 5.5%. That's going to be your interest rate for year 8 for that entire year. And then at year 9, they're going to do the same exercise again. They're going to take the margin, 2.5, and then they're going to look to see what the index is at that time. Add those two together, that's your interest rate for year 9. Which brings us to the next point, caps. So there are limitations on the ARMs. The ARMs can't just go crazy willy-nilly and just become whatever it's going to be. So typical caps you're going to see are 225. What that means is the first two that you see here is the maximum that the interest rate can change the first time. So going back to my example, if we have a 7-year ARM, at year 8, they're going to look at the margin, they're going to look at the index, and if I start at, let's say I started at 5.5%, the most it can change up to is 7.5, and the lowest it can change to is 3.5. So it's plus or minus 2%. There's a limit. The second number in this cap is the subsequent cap, which means year 9. So at year 9, we do the same exercise, and let's assume worst case scenario, I started at 5.5%. My first change date at year 8, it went up a full 2%, so now I'm at 7.5. Well, at year 9, they do the same calculation. Now the maximum it can change to is 9.5 or down to 5.5. Again, plus or minus 2%. And each year I'm going to do the same exercise. The third is what's called your lifetime cap. That means from beginning to end, your interest rate cannot change by more than 5%. So if I started at 5.5%, that means the maximum it could change to is 10.5%. Well, if I changed a full 2% the first year, the full 2% the second year, meaning year 8 and year 9, then at year 10, the most it could change at that point is 1 more percent, because I did 2, 2, the most is 1, because I'm going to hit my ceiling. So that's the worst case scenario. From lifetime, beginning to end, the maximum it can change is 5%. There are different variations. Sometimes you'll see what's called a 525. It just depends on which mortgage program you use. Now, just one last little tidbit here. Typically, if you pick a 5-year ARM, the bank to qualify you, because they don't know what the rate is going to do after the first 5 years, they're going to add 2% for what we call your qualifying rate. It is not the rate that you're going to pay, but they want to make sure that you can get qualified at 7.5%. So if the rate is 5.5, that's your note rate. They're going to qualify you. They're going to run your housing payment versus your income at 7.5 to make sure you got that buffer, that you're good, so that when and if interest rates do change, you can absorb that no problem, and they're not going to have to call you and say, hey, where's your mortgage payment? All right, so we've talked about the different types of mortgage programs. We've talked about the different types of mortgages. Stay tuned. Next, we're going to talk about the PITI. We'll be right back. Okay, welcome back. We're continuing our second segment of Mortgage 101. And what I've got up here on the whiteboard is what's commonly referred to as your PITI. And this is basically the makeup of your monthly mortgage payment. It has a couple of different parts. And The P stands for principal. That is the portion of your payment that is going back to pay the bank what you borrowed in order to get that loan. So if you borrowed $100,000, your principal is going to be going back to paying that $100,000 back. Now, the I stands for interest. So that is the cost to borrow that money from the bank. Obviously, we want as low interest rate as possible, but the interest rate that you get is all based upon your risk. If you're a higher risk, then your interest rate is going to be higher. If you're a lower risk, then your interest rate is going to be lower. Now, you might say, well, how do I make my risk lower? Well, you need to have a better credit score. So the higher your credit score is, the lower your interest rate. The lower your credit score is, the higher your interest rate. Or if you put more money down, or if you have good assets, or what we call reserves, that can help contribute towards getting a better interest rate. But the two main things is your credit score and the size of your down payment. We also call it in our industry the LTV, the loan to value, how much you're borrowing versus the property is worth. So your principal and interest. Now these two, what I like to call these two are, this is the portion of your payment that is going to repay what you borrowed. Now the next part here is your taxes. This is your property taxes. So what the lender is going to do is they're going to take your total tax bill. Let's just say for our illustration, your annual property tax bill is $3,600. They're going to divide it by 12. So they're going to collect $300 every month as a part of your payment. And that's going to go into an account called escrow. And I'm going to go ahead and put that on the board here. This is the second portion of your payment, which is your escrow. So that's just a fancy name for an account that the bank sets up for you. And 1/12 of your property taxes will go into the escrow. So $300 into your escrow every month. The next I is your insurance. That's your homeowner's insurance. That protects you in case something unfortunate happens to your house. So if, God forbid, your house burns down, or there's a storm and a tree falls on your house, this insurance will pay to rebuild the property that is the collateral for the bank. So you have your property taxes and your insurance, and again, the bank is going to collect 1/12 of your insurance, and they'll take that every month. So let's say your homeowner's insurance is $1,200 a month. Well, that means $100 a month in addition to your taxes of $300. So $400 a month is going into your escrow every single month, and it's going to accumulate over the year. And then as the property tax bill comes due, as the homeowner's insurance bill comes due, they just pay that right out of your escrow account. You don't have to worry about it. They're taking care of it for you. Now you might ask, well, why does the bank want to do that? Well, the bank is trying to protect their interest in your property as much as possible. If you fail to pay your property taxes, now again, your property taxes, most of it is your local government, so that's helping to pay for schools, infrastructure, all the local government services. So if you do not pay your property taxes, then the local government can put a lien on your property and force it up for tax sale. Well, the lender also has a lien on your house, and they don't want anything to happen to their lien. By forcing it up for tax sale, someone could buy the house out from under you. So they don't want that to happen. Same thing with insurance. If they've lent money on that property and that property burns down and there's no money or no insurance to put the house back together, that's a bad situation to be in. So the lenders want to try to mitigate risk as much as possible. So they're happy to do this for you. They'll set up the escrow. They will pay your taxes. They'll pay your insurance. Some lenders, not all, but some will even pay you interest on the money that's in your escrow account, kind of like the interest that you would make on a checking account. They'll do the same thing, but there's very few that do that. Now this last category down here may or may not apply to you, and that's PMI. And we talked about PMI earlier, where again, that's the insurance protection that the banks make you pay if you don't have 20% down. And that helps in case you stop paying on it, the bank has to foreclose. They sell the property at auction or on the market, and they don't get back at least what you owe on the property. That insurance kicks in and pays them the difference. Well, if you have a conventional loan, you're going to have PMI. If you have an FHA loan, that's called MIP. One thing that I may not have made clear earlier is on a conventional loan, your PMI will go away after you've reached that 20% down threshold. On an FHA loan, in most cases, it never goes away. So you're going to have that all the way until you pay that loan off entirely. Now over here I've got written LPMI, and that's another category. LPMI stands for Lender Paid Mortgage Insurance. Now the banks aren't going to just pay your mortgage insurance for you out of the kindness of their hearts. What this is they are saying, hey, we'll take care of the PMI, but in exchange we're going to give you a little bit higher interest rates. So what they're doing is they're taking the money from the extra interest that they're making, and they're paying the PMI for you. You might say, well, why would you do that? Well, this used to be more of a tax strategy, and it still could be effective for you. So I would highly recommend you talk to your CPA when deciding which mortgage option is the right one for you. But previously, PMI was tax deductible for households that made less than $100,000. Now, PMI is no longer tax deductible, so this may put more people over here in the LPMI bucket. Think about it this way. If I'm trying to maximize my tax savings, I want to be able to deduct as much as possible from my taxable income. In most cases, the mortgage interest that you pay is tax deductible. For most persons, this is going to be up to $750,000 of your primary mortgage. So if you bought a house or you mortgaged your property for anything $750,000 or less, that mortgage should be tax deductible. Now, disclaimer, I am not a CPA. I don't pretend to play one on TV. So you want to talk to your tax preparer about this, but the mortgage interest is tax deductible. And then previously, PMI was tax deductible for household less than $100,000. Well, if you happen to make good money, you're making over $100,000, or again today, PMI is no longer tax deductible. If you do LPMI, yes, you're going to get a little bit higher interest rate, but that's all interest. That's all tax deductible, as opposed to only being able to deduct the interest and not the PMI portion. If you move all of it under the interest category, you can now deduct all of that from your taxable income. So again, talk to your financial CPA, tax preparer, get their opinion on this, but this could be a way to maximize your tax savings benefit. So here we have it. You have your principal, your interest, taxes, insurance, possible PMI or MIP. That equals your total payment, or your PITI. Some people call it the PITI. But I hope you found this information helpful. If you're still not sure about which program is the right one for you, or you have some follow-up questions, again, feel free to reach out via text, by email, by phone. All of that contact information is down below. We look forward to helping you, and any questions that we can answer, just put them down in the description below, and we'll be sure to answer those as quickly as we can. Thanks again for watching. Don't forget to share, like, and subscribe, and we'll catch you next time.